Hello, everybody. This is Mike Blanchard. I'm here for our webinar on director compensation and compensation committee best practices. I thank all of you for attending today. I've got a lot of slides here I'm going to go over, but if anybody has any questions, there is a chat icon at the top of the screen. Go ahead and click that, fill in your question, and I'll do my best to identify it and talk about that or get to it, if not during the presentation, at the end of the presentation. But as I said, we're going to talk about director compensation. So I have some slides on that, and then we're going to go into other topics that impact the compensation committee. We're going to go over some executive related compensation committee concerns and topics that comp committees cover. And then we'll go over the best practices, how the committee structure, what tools they have, how they select numbers, a lot of good information on that. So we're going to cover these three topic areas. Uh, just so you know, a lot of the information from this presentation comes from our surveys. We do a lot of surveys at Blanchard Consulting. We do salaries and cash comp surveys. We do trend surveys. And we also do a director compensation survey. And obviously, this is where we got a lot of the information from the report, not only the numbers that you'll see throughout the report, but a lot of the best practices on how comp committees are structured and designed. So we use a lot of this data from the 238 banks that actually participated in our survey. It does break it down by asset size in our survey. I'm just going to show you the national results just to give you an idea of what's in there, but I strongly recommend if you do any analysis that you get a report that has customized asset cuts, because similar to executive compensation, board compensation increases as asset size increases. So let's get into it and talk a little bit about board compensation. And when you talk board compensation, it's a variety of areas. A lot of board compensation is paid in cash, and it could be a retainer, a meeting fee, committee fees, chair fees, but it's obviously paid in cash. You stroke a check at the end of the meeting or put it all in a retainer, and you pay it to them, and they're paid for their service on the board. In addition to cash, there are equity grants. Directors are often entitled to some form of stock grant as part of their service. Usually it's a stock award. So maybe it's at the end of the year. If you've attended at least 75% of the meetings, you're going to get so many shares of stock. And we look at the dollar value of that stock. Some will get stock options. Some are going to maybe have a restriction, a year vesting or something like that. But that's the most common form of compensation outside of cash. There might be some benefits. Some banks do have benefits where they maybe have a director deferred comp plan, maybe some other type of, some actually do cash incentives, although you'll see they're frowned upon. But what we tried to do in our survey and in our analysis is look at the total compensation for a director. Some trends in director compensation, uh, there have been gradual increases. So when directors do increase their compensation, which usually happens every 10 years, it's usually at a 5 to 10% rate. I think the average is 10%, but they average every 2 years. So when we age director data, we usually age it at about 5% per year. So it does go up on an annual basis, just like base salaries do. Usually there's a philosophy, and oftentimes it's the comp committee that's setting their own compensation levels. So it's nice to have a philosophy to go along with that. And many banks will have a philosophy for the executives, and it's usually a pay for performance. So if we perform, well, you get your base salary, but if we have good performance, you might get a cash bonus or you might get equity grants, but it's all based on achieving performance metrics throughout the year. Director comp is typically a little different. The philosophy for director compensation is typically a pay for time philosophy. So if you're spending a lot of time on board activities, more so than some of the other directors, and this usually is somebody who's on a lot of committees or chairing the board or chairing committees, they're spending more time on board activities. Therefore, they might make a little bit more. Usually it's about 20 to 30% more than the directors that are maybe just serving on the board and don't serve on a committee or maybe serve on one committee. So it's more of a pay for time. How much time are you spending on board activities? And we're going to compensate you if you're spending more time than other directors. As I said, annual incentives are frowned upon. Equity is the most common form of incentive, some type of stock type program. If you don't have real stock for directors, you could do phantom stock. Uh, and then there's been a trend to move more towards retainers. We'll talk about this as we get deeper into the report or the presentation. But many banks, especially if you get over a billion, more so if you get over 5 billion in assets, your compensation packages are pretty significant. You might be getting the 50, 60, 70, 80, $100,000. A lot of banks, instead of stroking, you know, 10, 15, 20 checks to a director per year, they just put it all into a retainer. So that retainer only approach has been increasing in prevalence, more so with the bigger banks. So let's start to get into some of our data that we have out there. What is that increase? We looked at it. It was 10% in 24, 8% in 25. It is changing. So it's important to do research to make sure your director fees are appropriate and reasonable. Also look at the asset size, because as asset size growth, you usually have increases of compensation there. So we do recommend you look at comp at least every 2 years and make adjustments accordingly. The interesting stat on the bottom of this table is how much time does an average director spend? So if our philosophy is pay for time, if you're a director, an average director spends about 6 to 8 hours a month on board activities. So if you're chairing the board, chairing committees, or serving a lot of committees, and you're spending 10, 15, 20 hours, you probably should be compensated a little more for that. So that's a good benchmark to use. 6 to 8 hours is the most common time spent by board members. If you're spending a lot more time, maybe that director or that group of directors deserves a little extra money for that extra time they're spending. What's the number of directors? This is important because it impacts compensation for the whole board. And you can see when you get towards a billion in assets, really over 500, it's about 10 to 11 directors. So that's the comment. If you only have 7 or 8 directors and you're over a billion, well, you could probably afford to pay yourself a little more because you're probably doing more work, because most of those other boards have 10 or 11 folks on there. But if you have 15 or 16 or 20 directors, it's going to be hard to pay everybody at market or above market because your total director comp is going to be a little higher. So it is important to look at the number of directors that you have, because that will impact your total director costs. Separate board chair and CEO. This is some of the trend data that we covered. Should you separate the board chair and the CEO? I know there's still a lot of chairman and CEO positions out there, but most of the time you can see about 80% of the time or so you have a separate board chair and CEO. Now, if you do happen to have the chairman CEO position out there, oftentimes that board will have a lead director that kind of assumes the responsibilities of the chair, especially if the CEO has to excuse themselves from the meeting. So that lead director comes prevalent and more common for those banks that have a combined chairperson and board. But most have separated those two duties. It's not like you're doing anything wrong if you haven't, but you might want to make some adjustments to the board to have a lead director. One aspect that I see, especially for when banks get larger and public, is having some type of ownership guidelines. And I think this makes sense. And it looks like a lot of banks will do that. Public's a little more so than the privates, but probably want to have your directors to have some equity in the organization. If they founded it, they probably have the founder shares and so forth, so they already have significant ownership. But if you're a public or you're private and have a lot of board members, it makes sense for them to have some ownership. And if you're going to give them equity or stock as part of the total compensation, you don't necessarily want them selling those shares as soon as they get them. So a lot of banks, about half of them out here, have some type of ownership requirements. It's usually a multiple of 3, 5 times your annual director comp. And usually, if you just started, you might have 3 to 5 years to gain that. But if you do decide to incorporate equity as part of your total compensation plans for your boards, it might make sense to have some ownership requirements. As long as you serve on the board, we expect you to to own a certain dollar amount of shares. Or it might be a number of shares. But having ownership requirements, I think, makes a lot of sense, and something that you want your directors to have some stake in the game. A mandatory retirement age. This is always an interesting one to talk to directors about, but you can see about 4 in 10 banks have them. Public banks a little more than the privates once again. The average retirement age is 72. So it's a good way to get some turnover on the board. I always say, be careful because you got some really good board members who are in their 70s. We might not want to lose them. If you don't have retirement requirements, maybe you have board evaluations to make sure they're still doing their job. But some banks have adopted this. You can see in the average age is 72, the range is 65 to 80. So an interesting trend on board or director retirement age. Benefits, not a lot of benefits to directors. They tend to be costly. Equity plan is a benefit, so we consider that. That's the most common one out there. Some directors will have a deferred comp plan. So basically, and I think this makes sense for many banks to have just a deferred comp where you can put your cash director fees into a deferred comp plan, especially if the director does not need the cash right now. They could put that cash into a deferred comp, maybe get paid out a little later on in life. Maybe they're in a different tax bracket. It's a nice little supplement to a retirement package and a very low cost to the bank if you're not adding any additional compensation to that. I know there's some deferred comp plans where they'll actually continue to pay them, emeritus directors and so forth, and that could get costly. So just be careful if you have a deferred comp or retirement plan. Not many have retirement. Make sure that you include the cost, the accrual cost of those deferred comp and retirement benefits into the total comp package. Life insurance, health insurance, they're usually a little too costly for directors, so we don't see that being very prevalent along with stock purchase plans. The most common one is the reimbursement for travel expenses. Most banks will do that and send the directors to the state association conference or bank director conference. Those costs are usually absorbed by the bank, and if you know it's basically part of the job, but you'll pay for their expenses and maybe even a spouse too. About 30% don't have any benefits at all. So they are somewhat limited. That's why our survey includes those if you have them. But what we typically focus on when we design director comp packages is a piece of the director comp in cash and a piece of it in equity if you can do equity grants. So that's kind of the trends and best practices from our director comp survey. Here's where we actually get into some numbers. And remember, this is all 238 banks. So it includes the banks under 100 million and banks over 5 or 10 billion in assets. So yeah, we have a range, and there's more of our banks that are under a billion than over a billion. So this is skewed a little bit. The average assets is 534 million. So this probably fits in line with the $534 million bank. Now, we have done some research. Public banks do pay a little more than privates. So if you're a public bank, you usually get a 10 to 20 to 30% bump because there's a little more risk there. This includes both publics and privates. But what it tells you is it tells you a story. And before you email me with questions, don't add up the rows. Because if you look at the 50th percentile, which is what most comp consultants look at, you'll see the cash paid in cash is about 21,000, then 15,000 in stock awards, 5,000 in options, your total equity 15. We know that doesn't add up to 24, which is the total comp. Well, how this chart works is it for those that have stock awards, and not everybody does it, when a bank puts stock awards in place, it's usually around 10 to 15 to $25,000 worth of stock. Now, you can't necessarily have a cash comp package that's 30,000 and then another 15 in cash and expect to be at the meeting in the market. You would take away a little of the cash if you add 10 to $15,000 worth of equity to the table. The incentive comp's out there. The sample size is low, but some banks do pay cash bonuses to directors. The regulators, NASPP, are not the National Association of Corporate Directors, NACD. They frown upon cash bonuses to directors. The reason is they don't want directors to make decisions just so they could get a $3, $4, $11,000 bonus at the end of the year. We'd rather have them give them incentives that is linked to long-term success. And most agree that the best practice for an incentive for directors is in the form of equity or some deferred comp where the interest is linked to building shareholder value over time. So it's out there. You might not get dinged for it, but it's not considered a best practice to have what we call a non-equity incentive comp plan, which is basically a cash incentive plan. But it's out there. Change your retirement benefits when it's out there. It looks very similar to the equity grants. And then other comp is some of the travel benefits or other benefits that you get. But the most important number on this chart is that total comp per average director. So if you're a $500 million bank and looking at all banks, not public banks, about $25,000 would be the average total comp when you add everything director for an average director. If you're a smaller board, you're serving on a lot of committees, you're chairing the board, your comp is more likely to be towards the 75th percentile market or around 35,000. Now, these numbers increase dramatically when you get over $1 billion in assets. I don't have the numbers here, but that's where the comp packages, depending on your location, could be 40, 50, 60, $80,000. So I'm giving you a little data to kind of show you what it looks like for all banks out there, but we really recommend you do this analysis by asset size and look at asset size banks if you can by your region. There's not a lot of good board data out there. That's why we did this survey about 10 years ago. But sometimes your state associations, some other uh, uh, survey firms have director comp surveys, but it's important to try and get that total number. So you factor in what benefits, equity, all that's taken into consideration so we know what an appropriate total comp package for our directors is. So this is for an average director. It takes out the chair. Um, this is for all directors as a whole. So when you look at all directors, it's somewhere between 150 to almost $300,000. So this is important. This is where the number of directors impacts your total compensation. So if you have fewer directors, you can pay them a little more and still stay in that 150 to $200,000 range, whatever your philosophy is for paying directors. So it's important to look at the number of directors. If we have too many, it's going to be hard to pay competitive compensation. So when we're going out there and trying to attract directors, and I don't know why you would if you already have 15 or 20 of them, it might be difficult if your average comp is not competitive. So it's a lot of good information to look at total compensation, but also to see how it all fits together. So we did a little more analysis just to see what those different levels look like when we do break them out. So one thing we looked at was for those banks that actually pay a retainer, could be in the form of cash or equity or a combination of the two, what does it look like? And we looked at holding company and bank board. Usually banks will pay one or the other. If you pay both, it's usually at the lower end because you can't afford to pay $1,000 for each meeting, or it might be too excessive. But when you look at retainers, depending if it's bank board or holding company board, you can see 6, 10, 22, 8, 14, 24,000. It's a significant piece of the total compensation package. Now, you might have meeting fees. If you have meeting fees, the average is somewhere between $750 to $1,000. At the high end, it could go up to about $1,500. So this gives you some data. You can take a look to see how does our meeting fees or how do our retainers compare. But like I said, importantly, let's see how they add up. Now, I briefly talked about this before, who's doing retainer onlys or meeting fees only. And you can see it's still prevalent, especially for smaller banks under $1 billion, to have the meeting fees only. It starts to change a little bit when you get over 500 million, where you could see there's 18% retainer only, but 37% using a combination of the two. And then when you get higher than $1 billion, it starts to get a little more prevalent to have a retainer only approach where 33 or 40% are doing it. So it's something to think of. And the biggest reason why I see many banks go to retainer only is the ease of administration. Like I said, it's a lot easier to stroke one check for 20, 30, $40,000 than to stroke 15 checks throughout the year. So something to consider if it makes sense. Now you have to customize this. I've seen these retainer approaches where the retainers differ for each board member depending on how many committees they serve on and if they chair a committee or the board. And basically you would just add, your base retainer, if you're on the board, might be 15 or $20,000, and you get an extra 5,000 if you're on a committee, another extra 5,000 if you serve on the chair of that committee, and it could total up and everybody's a little different. But once again, it's easy. You're not stroking checks at every board or committee meeting. You just do one check a year. So something to think about as you grow to make sure you have, it's easy to do. And it's a little easier to understand what your total comp is too at that level because you're not trying to measure, 5, 10, 15 different items. Additional fees, who pays additional fees to chairpersons or the lead director? You can see it varies. Some banks don't pay any additional comp to committee chairs because they're not really doing any extra work. It's not like they're spending hours a month preparing for their meetings. they just sit in and basically like everybody else, they just lead the meeting and then absorb the information as it come, or maybe read the materials that's sent before the meetings. But there's many committee chair that does do a lot of work, and in those instances, they're getting paid a little extra for it, especially over $1 billion in assets. The board chair, it's mixed again. About half of them over $1 billion are getting additional compensation, some are not. Um, Really, it depends on like I said, how much time they're spending on board activities. If the chair's spending 20, 25 hours a month, more so than the typical 6 to 8 hours, then probably should get a little extra money for that additional responsibility. You can see here it ranges from anywhere between just $1,000 or so to $21,000 for a board chair. Committee chairs, they'll usually get 100 to 200, 400 is a little small, but I usually see it around three, four, $5,000 they get for being that chair of that committee. Audit committee chairs, those are the folks that oftentimes do get significant compensation because you have to get a CPA on board. You need to pay for that expertise. They typically I've seen them get paid as high as $8, 10, $15,000, depending on the size of the bank, to be the chair of the audit committee. Comp committee chairs, they're getting a lot more because there's a lot more responsibility for comp committee chairs. So once again, it's that time philosophy. How much time are you spending extra? If you're spending significant time or we need significant expertise, we typically pay a little extra for that. And it's usually $3,000 to $4,000 to $5,000 for a committee chair and could be up to 10 to 20 for a board chair. Here's a little extra data we see when you break it down. You can see this is all banks. So you could see here's where you're getting another $10,000, $16,000 for a board chair, another two, four, three, four, $5,000 for the committee chair. How much do you get paid per committee meeting? Usually they do pay for committee meetings. I know some banks will just roll it into the retainer, but you can see here, and this is all asset sizes. These committee meetings will range from $200 to $500 per meeting. So it's a significant pay for those meetings. And if you have really long meetings, you might be paid a little more. If it's an executive committee, you might be paid a little less. Loan committees are always the wild card out there because some banks will meet, 15, 20, sometimes every week. And those fees could get pretty high, but you're meeting every week, so you're spending a lot more time. It can be justified. But that's the typical range, anywhere from about $200 to $500 per committee fee. So like I said, the most important thing is to add them all up to see how your total compensation for an average director compares to market. And we can use some data, some quantifiable data to help make those decisions, which helps when you're a board member setting your own salary. You want to have a lot of data to help support that in case a regulator, or if you're public, an institutional shareholder, or anybody questions it. We have a philosophy, pay for time philosophy. We use market data to make sure our board compensation plans are appropriate. So that's a lot of information on board compensation. Like I said, make sure you look at it by asset size and and try to find some good data out there. We've got our survey out there. If you go to our website, you could find it. And we do have it broken down by asset size. If you're competing with publicly traded banks for directors, or if you are a publicly traded bank, my recommendation is go out there and get a peer group of other public banks in your region. We do this a lot for executive comp. We could do the same thing for director comp, where we look at your asset size range. It's usually about 75%, 2 to 2.5 times your current asset. Try and get at least 15 public banks out there. Usually it's up to 24 or 25, and do an analysis on those public banks to find out what they pay their average director or chairs or whatever. They have to disclose all this information in their proxy statement. So it's a nice resource for data, is to go out there, find the public banks, do an analysis, and see how your director comp compares to market, and then you have some information to help make those changes. So then we get into director comp committees and executive concerns. So as a comp committee, we'll get into the best practices. Most of the time, the comp committee, not only setting their own compensation, but they're most importantly, I shouldn't say important because it's important for everybody to get paid, but their duty to the shareholders is to make sure the executive compensation is appropriate, reasonable, and meets regulatory guidelines. And that regulatory guidelines is a big thing because a lot has changed over the past 20 years, 25 years in bank compensation. And I started bank compensation back in 2000 and did a lot of studies in, the beginning of 2000, 2005, 2006, 2007, and banks were churning, making a lot of money, paying their executives and directors well, and all of a sudden the credit crisis hits it. And when the credit crisis came about, and I'm in Atlanta, and I've been in Atlanta since 2003. Uh, that impacted compensation because a lot of banks that failed in 2008, nine, maybe started in seven, the regulators thought that some of this was due to the incentive plans that might have encouraged too much risk. So, and this might have been true. I've saw a lot of these CEO incentive plans in the Southeast, and I've had a lot of work in the Georgia, Florida market, and they had incentive plans that paid out a heck of a lot of money. They had bonus pool approaches. They get a percentage of net income over a 1.0 ROA, and I would see these payouts that were two, three times their salary. And then we saw what happened to a lot of those banks in 2008, 9, and 10. They failed. The regulators came out with guidelines in 2010 for all banks to follow. They like incentives for executives, but they want to make sure that incentives are designed appropriately and don't encourage any unnecessary risk. And the regulators came out with these sound incentive compensation guidelines in June 2010. I've kind of summarized them on this chart here. And basically, what these guidelines stated is they wanted to make sure the directors have the responsibility, and they really want you to have a compensation committee, which is why I'm doing this presentation. I've been doing it for the last 16 years. They want the comp committee to ensure that any incentive plan for anybody at the bank complies with regulatory guidelines and doesn't encourage any unnecessary risk. So basically, and this applies to any bank, the public banks, they're scrutinized already by the SEC. This is private banks, family-owned mutuals, any bank out there. If they have a pay for performance plan, their board needs to look at it and make sure it's designed appropriately. They have other guidelines, Dodd-Frank, the SEC, shareholder interest groups, where they have all kinds of guidelines you have to follow. But these guidelines by the regulators from June 2010 impact every bank. And the big thing, what they ask for is for the board or comp committee to do a risk review of their annual incentive plans. So any incentive plan, whether it pays in cash or equity, needs to be analyzed and thought through by the board to make sure the plan doesn't encourage any unnecessary risk. So we included this guide, this 7-step guide of things to look at when you review your incentive plans. And many banks have done this. The public banks are required to do this. If you haven't done it, we highly recommend you do this and then update it every year. So you basically do it the first time, that's the hardest, and then tweak it if they made any changes each year. But what they want to know is how you've mitigated risk. And number one here is we don't want any excessive incentive payouts that might encourage risk. So that uncapped plan, that bonus pool, the ROA pool that you could get unlimited payouts, not viewed as appropriate by the regulators. They like plans that have caps on it. Now, the caps could be reasonable. That's why we do our market research to say, okay, should the cap be at 50% of salary, 100% of salary, 150% of salary? Well, a lot of it depends on asset size and what your peers are doing, but we don't like an uncapped plan. We want a capped plan where we cap our incentive opportunities so they're not incentive to do anything risky, just to bring in money and get paid today, and who knows what happens tomorrow. They want you to, number two, review the performance measures. Make sure you're not setting goals that are too high, too risky, or too low for that matter. They want to make sure that you have goals in there that are linked to the long-term viability, not just on profit. So that's why many plans after the credit crisis, obviously net income, ROA, ROE are the most common goals out there, but we'd have some strategic goals or discretion even in there at 15, 25% of the weighting. Where most recently it's been core deposits. So yes, we want to bring in our net income or ROA, ROE, but we also want to grow core deposits. So we incorporate core deposits, a strategic goal that's linked to the long-term success of the organization, into the incentive plan design. So look at your performance measures, make sure they're designed appropriately. We're not setting them too high or too low. Um, we have goals that are linked to the long-term success or strategic plan. We have some type of qualifier, whether it be credit quality or satisfactory regulatory ratings. We want to make sure that we have something in place that makes sure we're doing things the right way to help mitigate risk in these incentive plans. Make sure your targets aren't too high or too low. appropriate. This is why I see many comp committees, when they're setting goals for their incentive plan, they'll take a look to see what our peers are doing. So I'm in Georgia. If I'm in Georgia Bank, I might want to take, when I set my net income goal or my ROA goal, I might want to look at our peers, other banks in Georgia. How is their ROA doing? Where do we set? And this kind of mixes into a philosophy for executives is the way we can justify a high bonus. So if we go to the maximum bonus of 50, 60, 100% of salary, we want to make sure our performance is at the upper quartile of market. So that's why it's important to do some peer group research out there so we feel comfortable about the goals we set at target or our budget and what goals we set at maximum. Multi-year performance goals, yeah, those are great to have if you find out a good goal. Sometimes it's hard to identify where you're going to be 3 years from now. Uh, but this is where some peer group metrics might come into play. This is where stock compensation comes into play. Because with stock compensation, you get paid in stock, but usually there's a vesting period. You have to wait till you get that stock for 3, 4, 5 years. Well, the goal, the incentive there is we build shareholder value so that stock price takes off. So the stock that we got that might have been worth $10 a share today, hopefully it's worth 15 or 20 5 years from now, and we get value. So that inherent long-term or multi-year approach is in stock plans. And that's why we recommend stock plans for banks that are growing or over 500 to a billion in assets. That's when you should start thinking about incorporating stock into your top executives. I'm not talking about producers. Usually stock is used for retention for them if you use stock or cash. For executives, we recommend stock be part of that total comp package. So they have a piece of their compensation package that's linked to long-term success of the bank and shareholder value. Appropriate governance, communication. This is where we want to document our plans. So if the regulators ever come in, we can show them how our plans work. Here's the documents. We've got a comp committee that governs us. We're following all the best practices. And here's our risk assessment so you can see how they don't encourage risk. Clawback policy is one that's now required for public banks. For those of you that don't have a clawback or don't know what a clawback is, it's basically a policy that really became popular about 10, 15 years ago, or after the credit crisis, where if an incentive is paid out in error, so we paid out the CEO, we gave the CEO a $200,000 bonus, but we had to restate earnings 6 months later, and we probably should only paid $100,000. A clawback policy would give the bank the right to get that money back from the CEO because it was paid in error. Now, the comp committee has a lot of discretion on this, but it's a good policy. The regulators love this policy. Public bank shareholder service groups want this policy in there. I think you have to have it in now. But it's something to help mitigate risk because if something goes bad, we might have to pay this money back. Now, it brings up the next question is how do we pay it back? We've already paid taxes on it. We've already spent it. This is where it's important for bullet number 7 to have some type of deferred compensation out there. But it could be a cash bonus, it could be a stock grant, it could be a retirement benefit, but that's usually where the clawback comes from. So it's important to have not only your salary and competitive bonus in place, but have some form of stock grant or deferred comp. One, to help keep them because that's what they lose if they leave. So it's great retention, but it's also important to have where we can implement our clawbacks if we ever need to. So these are how the comp committee is being involved in executive comp and using best practices and good corporate governance, at least for the risk assessment. Here's some data on the clawbacks. You'll see that they're not nearly as prevalent as you're under a billion as they are over a billion, but something to consider having a clawback. And here's a sample of clawback policies on 23 here. The other aspect is the ownership guidelines for the executives. I talked briefly about this for the directors. If you have a director, you want them to have some stake in the game. Well, if you incorporate equity into the compensation plan, and this is more for your C-suite officers, it's probably good that they don't sell those shares soon after they get it. So we might have some ownership guidelines for them. It's usually a multiple of salary. For the CEO, it might be 2 to 3 times their salary. For others, it might be 50% to 1 times their salary. But we would expect them to own that number of shares over maybe a 3-year period if you just start this out. But we want them to have shares and maintain that ownership level to be an executive officer of our bank. So something to think about. And oftentimes the comp committees are involved in this with executive compensation. So that's a little bit on how comp committees have been interacting with the executives on helping setting and reviewing and analyzing compensation and putting in programs. Let's talk a little bit about best practices for comp committees. So a comp committee is usually, and I'll talk about this later, about 3 or 4 members, and they talk about just about any area of compensation in the bank. Could be, executive salaries, your incentive plans, cash or equity, the risk reviews, board compensation, even pay equity and ESG. These are topics that have been top of mind for the last 5 years or so. Anything that impacts compensation is typically covered by the compensation committee. Um, about 68%, so about 2/3 of the banks have a formal comp committee. So there's still 32% that don't have a comp committee. Usually it's the executive committee that's handling this. If there's anybody on this call that doesn't have a comp committee, I strongly recommend that you create a comp committee. It's important, especially as you start to grow, if you have growth plans and you get to over 500, over a billion, a comp committee, I think, becomes essential. Uh, so having a comp committee, usually, as you see here, the membership is about 3 to 5 outside independent directors. The CEO is usually not a member, an official member of the committee. They usually sit in on all the committee meetings, but they'll usually excuse themselves when we talk CEO compensation. Another great resource, if you're not using this already, I strongly recommend, especially a bigger bank, and if you have a CHRO, a Chief Human Resource Officer, or even your risk officer, because they can help with those risk assessments, sometimes they serve as advisors. In many of my public banks or my banks over a billion, more so over 5 billion assets, that CHRO attends every comp committee meeting. They're a resource. They have their finger on the pulse of the company. They have know where all the plans are. They're a valuable resource to the comp committee and work hand in hand with them. Do you rotate membership? There's a debate on that one because there's a lot of education that goes into comp committees, especially that chair position. So, do you rotate every 2 to 3 years? That might make sense, but I know some banks have kept it steady. Um, so that's something to think about. Do we rotate or not? Who nominates directors? It's usually the nominating committee, not the CEO. There might be a conflict of interest if the CEO is nominating the comp committee. Whoever chairs the committee usually requires a little of experience. So they will attend webinars like this. Bank director has a great conference for committee chairs, a lot of resources, but oftentimes the comp committee member is not really an expert in compensation when they start their chairperson responsibilities, but by the time they're finished, they know about just about every area of compensation. So it's important to get that chair really educated, and then they can help coach all the other members of the comp committee. If you're on the comp committee, it's important to have independence. The SEC, if you're publicly traded, has specific rules for independence. They don't want the director to be an employee, so they should be a non-employee of the bank. They shouldn't be receiving any consulting or advisory income. Their business shouldn't be doing any business for the bank. They shouldn't have a personal business relationship with any employee of the bank, no relatives and so forth. And I realize that sometimes you have a family-owned bank, and you might have some of these conflicts, potential conflicts, I should say, out there. It's important that if there is a conflict, you address it. The comp committee realizes it. Maybe that director excuses themselves if you're talking about their relatives' compensation. That might be a good idea. And really take a hard look if they're doing any business from the bank. Does it does it have any potential conflict of interest? Where if the director is a friend or if it's a relative or if they're doing business with a certain executive or officer, it might make sense for them to abstain from voting or opining on that person's compensation package. So it's important to have independence for your comp committee members because you don't want anything influencing these decisions. Now, if you use a consultant, and I'm a consultant, so I fill out a form for all my public banks to show them that I am independent. They should be independent too, because the consultant is providing a lot of information to you. So they probably shouldn't be providing any other services to the bank. I think Enron way back in the 90s got in trouble for this. They were doing all types of consulting. They were doing comp consulting, but they also had a big accounting and other advisory departments. And there was a conflict of interest where, okay, if I'm working with the CFO, I'm certain he or she definitely deserves a raise. We want them to continue to do whatever else we're doing. I know that sometimes there's some insurance folks out there that sell the bank-owned life insurance that also do comp consulting. You got to be careful because they might be more inclined to push their benefit plans to fund BOLI rather than being a true comp consultant. So you should have independence. You shouldn't provide any other services. What is the amount of fees? Probably should be less than 2 or 3% of your total fees because you don't want to relying too much on one bank or there might be a conflict in there. Are there any policies of who you report to with public companies? I usually will report to the comp committee. Does the advisor, your consultant, have any relationships with any members of the comp committee or any employees? Does your advisor own stock? That's a no-no. I shouldn't have stock, so I'm not able to invest in banks because I want them to be a client. I'm not going to invest in them because there could be a conflict of interest there. And do you have any relationships with any officers at the bank? So not only should the comp committee be independent, but the folks that advise the comp committee should be independent too. This charter statement is one of the most important aspects of a comp committee because I know a lot of banks are hesitant to go to a comp committee. They don't want the comp committee necessarily micromanaging all employees at the bank, and they probably shouldn't. But the charter kind of defines all the responsibilities for you. And if you don't have a charter, here's some of the rules of engagement. I have some sample charters. So if you get with me or one of our other consultants, Matt Fry or Jeff Fairchild, we'd be happy to share a sample charter with you. So get in touch with us afterwards. We'll share that with you. But it basically will define, okay, one, who do we review? Who are we accountable for setting compensation? It's usually the CEO. That's a no-brainer. Usually the board. Uh, who else? Do we go down lower? Usually that for public companies, it's that executive, that C-suites that we have to report in our proxy. But you usually don't go much below that executive management team or senior management team. The comp committee doesn't need to be setting salaries necessarily for loan officers or tellers. Let's set a philosophy in place, a policy, and then make sure that our executives follow that policy. So we don't need to be setting salaries for everybody outside of the CEO and maybe those executive team members. Let's just set a policy going down forward. We need to look at the incentive plans. So we need to make sure we look at the incentive plans. Um, Maybe we look at benefit plans and change control agreements. These are all in the charter statement. So it defines who we're looking at and what we're looking at. And then, obviously the charter will talk about, okay, how are we structured? Do we have independence, education, those types of things? Usually the philosophy statement for the executives and board is in the charter too. It might be the second or third page, but it's nice to have that in there too, because that really outlines how we pay our people. And it's nice to have a document. So if it ever comes down to it, we change comp committee members, we have a charter, we could go back that kind of gives the rules of engagement. So that's a charter, important to have. Who has philosophies? This is that philosophy. About two-thirds of the bank either have a written or informal philosophy. There's still about a third that don't have this in place. Um, I strongly recommend to have a written philosophy. Because if we write it down, then we can always refer back to it and things don't tend to change. It's just like compensation plans. If I'm doing incentive planning or equity planning, I always say, let's get a document because I always am worried if we don't have a document or something to administer the plan, at the end of the year and the money's on the table, arms get long and memories get short. So it's nice to have everything written down so we're all on the same page. So I really recommend for those of you, if you don't have a philosophy, let's get one. And once again, I'll give you a sample one if you want it. But let's write it down so we're all on the same page. And instead of having an informal or none, we have a written philosophy that we can go back to. And at the end of the day, it's good to have because it guides the decision and something you can communicate to shareholders or regulators. This is our philosophy. It's not, which way the wind's blowing, but this is our philosophy. And usually it's pretty simple. For an executive, we're gonna pay salaries around the midpoint of market, maybe a little higher if you have more experience. But for total compensation, When you factor in cash bonuses and stock grants, our total compensation will be at the 50th percentile if we're meeting expectations. We're hitting budget. We did our peer analysis. We're performing at the midpoint of market. We're going to pay competitive cash bonuses, equity grants. Our total compensation is going to be close to the 50th percentile of market. If we happen to hit a home run, we beat budget by 10, 20, 30%. We're outperforming our peers. Our incentive plans will move compensation to the 75th or upper quartile of market. So obviously you need to do some research to find out what the 50th and 75th percentile market is. But if you have that philosophy and you have good market data to support it, it makes it a lot easier to defend and talk about compensation because we have a plan. This is our philosophy. This is how we compensate our folks. And we feel comfortable and it gives us a sense of security that we're doing the right thing. Here's the philosophy statement. Like I said, it covers all areas: salary, cash bonuses, then all the other forms of compensation, equity retirements, and perquisites. Another great tool to have for the comp committee, which I found has been very helpful, is if you're going to have 4 meetings a year, and that's most comp committees have 3 to 4 meetings per year, is to have a calendar out there. So how does our calendar work? Well, we have different tasks we're going to accomplish throughout the year. At the beginning of the year, that first quarter meeting, well, it's decision-making time. We need to finalize the CEO performance review, determine their salary or the other officers. What is our equity? We probably have a good idea of what our cash and equity incentives are. When are we going to pay those? Are we okay? Let's approve those in January or February. Maybe we finalize the goals for the plan for the next year. So we do a lot of decision making and planning. If you're public, you start filing, and then the second quarter, well, we've done a lot of the background work. Let's talk more about, maybe talking about the incentive plans and finalizing, or maybe we do that risk review. That second and third quarter meetings, they can be combined into one sometimes. If you're doing a big study, you might need, both meetings. If you're not doing much that year, if you do a study every 2 to 3 years, maybe you can combine those two. But you're doing all the other important things: the risk reviews, the charter, maybe some education, taking a look at those incentive plans, doing a pay for performance analysis. And then the fourth quarter is basically the end of the year. Are we making any changes to director comp? Where are we looking at for our incentives? Do we have enough money? Are we paying incentives or not? Review the comp committee performance, doing some evaluations and so forth. Those are important to do at the end of the year. So it is nice to have a calendar like this so we know what we're supposed to accomplish. So we're not going to meetings saying, what are we doing this time? We have some goals, and then depending on the year and what we're doing that year, we could either have 3 or 4 meetings. So it's important to have this calendar that outlines what we're going to do for these meetings. Like I said, 3 to 4 meetings. The chairperson usually leads the meetings and makes sure that we have adequate time. We make sure that our minutes are distributed, or if we're doing a comp review report, that's distributed everything before the meeting. We need to make sure we take good minutes. That's an obvious one for any committee meeting, but even more so important for compensation because we're making a lot of decisions. We need to document those. Usually you'll invite a consultant or other officers, and the agenda is usually done by the chair. Sometimes you'll involve the CEO or some of your management teams to help set that. It's usually a group effort between the comp committee or the chair and the CEO, or maybe a couple other of the executive officers to come up with the meeting. Sometimes you'll have a pre-meeting with the chair to ensure the agendas, and usually at the end of the board meeting, there's an executive committee where you maybe will excuse the executives because the board can talk together with a consultant. But these are typically how the meetings are constructed and what happens during the meetings. One other thing that has become more popular these days is doing some forms of evaluations. Now, most of the banks out there that I've worked with are doing an evaluation for the CEO position. We actually work with a lot of banks and financial institutions on doing CEO evaluations, and usually it's done by the board. So they're responsible for doing the evaluation. So they'll either do it themselves on an annual evaluation, Sometimes they'll use consultants. It's nice to have consultants to do this, especially if you're evaluating the board. And I see that many more banks do the CEO rather than the board. And I always ask, well, if you evaluate the CEO, why aren't you evaluating yourself? But that one seems a little longer to adopt. But it's important. I think for the CEO, it's important to make sure the CEO not only meets the financial goals, because hopefully they're rewarded through the incentive plan for that, but they're doing all the other things we expect from the CEO. They're developing the leadership team. They're communicating well with the board and all employees. They're developing employees. Those are the softer things that you can measure through a performance evaluation, and really see if the CEO is doing the strategic objectives in addition to the financial metrics. And more frequently in incentive plan designs, which the comp committee usually is heavily involved for the CEO, I see what we call a discretionary component in the incentive plans. It might be a small piece of the pie. It might only be 10, 15% of the earning potential, but if you have a discretionary component, it allows the board or the comp committee to reward the CEO for doing all the other things. So it might have been a tough year. We didn't quite make it on our net income or ROA or core deposit growth number, but the CEO did so many other things. We want to give them a little something. So we can basically give them a max out 10 to 15% of the earning potential. I've seen as high as 25% to reward that position. It could be the CEO, CFO, or COO for all the strategic goals they accomplished. But the best way to measure that is through a performance evaluation. Now, for the board, the performance evaluation is to make sure each board member is contributing, or the board as a whole is contributing. So for the board, we may be looking at things such as, first off, did you attend all the meetings? I can't remember if I have a slide here. I have some slides in here on board evaluations. Are they participating? Are they coming prepared to meetings? Are they providing input? These are things, and usually what I'll see is banks will start with evaluating the whole board. So you might have a 1 through 5 rating scale on maybe 10, 15, 20 different questions. Does the board do this? Does it do this? Did you meet? Did you exceed? Did are we not happy with it? And basically, if you start getting some not happies with it or not satisfied with it, then maybe instead of measuring the whole board's performance, we start doing individual directors. And I've seen a few banks do this where they'll evaluate the whole board, and then they'll evaluate each director, and then they'll evaluate themselves. So it's more of a 360 evaluation. Now, usually it comes because we're having some problems with a board director or two. And that's a good way to call them out and make sure that they're doing what they need to do. And if this is anonymous, done by a third party, other board members might feel comfortable, identifying a director that maybe needs to work on something. It's not necessarily a bad thing. We usually do it for our employees. We do it for the CEO. Why not evaluate the directors? If you're doing that, more often than not, the comp committee will head up that responsibility. So something to think about. Obviously, I think you need to do it for sure for the CEO, but should we measure board performance? Maybe we just measure it as a whole to see if there's any potential problems. If there are, maybe we could dig a little deeper. This reference book is another best practice that I see out there. I think this is really important to have. And maybe it's not a book anymore. I need to get updated and call it the portal, because that's what most banks have these days, is a portal. But as a comp committee member, you're in charge of a lot of different compensation plans. So it's important to have a portal or some access. And this is where HR will oftentimes come in handy, because they're oftentimes managing and really working on this portal. Is you'll have the charter. So if you need the charter, a couple clicks of the button, all of a sudden the charter appears on the screen. What about our calendar, our agendas? What about compensation plans? What did we put as goals in our cash bonus plan? I've been there many times and we can't remember in September what we decided on in January or February. We pull that up. Where are we performing? How are we? Then we could pull that up through the portal. So having a portal that has all this information, hopefully organized. Maybe it's that comp review report. Blanchard gave us this study in July, but now we're in November, December. We need to make decisions. Let's pull up that report and see where we are on salaries. That's going to help us with our salary decisions for our top 5 executives. It's important to have this in there. Education materials. What was that new guideline or regulation out there? Anything that's important, it's good to have in some type of reference book, so we can have it at the at the click of our fingers rather than having to wait till the next meeting to discuss it. So this is a nice tool for comp committees to be effective. So I have about 5 minutes here. I didn't get any questions, but I just kind of wanted to review things and kind of talk about some best practices and emerging trends for a few minutes, and then I'll leave it a few open for questions. And obviously, you can follow up with me afterwards if you have any questions, either me or Elise. I think Elise has a recording of this too. She could share with you. But when you're thinking about board compensate or compensation and all for the CEO, we talked a little bit already about the evaluations. I think that's important. Those equity ownership guidelines, that's important to have. Equity grant practices. I didn't go too much detail into this, but I've worked with a lot of compensation committees on equity compensation. And first off, the first question is can we do equity grants? It's something every comp committee should ask because it's out there. If you look at the prevalence data, especially over 1 billion, I'd say, about 2/3 of the banks have some form of equity compensation. Either it's real stock or phantom stock out there. How do we do this? Do we have the ability to do this? If we don't have real equity, do we do phantoms to equity, which is really deferred cash compensation? But how often do we grant this? Some banks will just do it as retention and as needed. We recommend doing it on an annual basis. Should we do it on an annual basis based on performance goals? This has been a big trend for banks as they grow and they get to over 1 billion in assets is how do we deal with equity compensation? How do we grant it? Is it every year? What performance goals do we use? Do we put ownership requirements on there and so forth? So that's one a hot topic these days. Succession planning is another one. Oftentimes the comp committee will handle this. Yeah, the regulators want to see a succession plan, so we better have one at least for the CEO. But do we have one for other key positions? And how's that succession plan structured? Is it just, if he gets hit by or she gets hit by the bus, who replaces him? Do we have any internal candidates? What if we have to go external, or where are we going to go? That's where we maybe use the market research. Have a good succession planning process documented. It's usually oftentimes handled by the compensation committee. The education, I strongly recommend getting some educations. Usually the charter will have requirement. Go out there and look at the conferences out there, these types of webinars. There's the bank director conference. We're actually doing a conference. Blanchard's doing our first conference this year on compensation. It's structured a lot for HR directors, but we have a few comp chairs and executive officers attending that too, because there's not a lot of compensation specific conferences out there. You look at the market trends and regulations. Always need to keep a handle on that. That's why sometimes it's good to have that chief risk officer involved because they'll have their fingers on what's happening with the regulatory guidelines out there because things change. If you're SEC, you really need somebody involved with that because they change the guidelines a lot. Those ISS and Glass Lewis, those shareholder service groups. A couple others that have raised their head over the past 3 or 4 years, ESG, the environment, social governance, that for publicly traded organizations, the shareholders want to see what we're doing to make sure we protect the environment and have equal pay and good governance. And this is where the DEI, diversity, equity, inclusion, that's a big one out there. We want to be able to show, especially if we're public and we have to file a proxy statement, that we're treating our employees fairly, that we're not no pay discrimination. We have diversity. We're good to the environment. These are nice to have. So this is just some emerging trends and best practices out there. So let's see. Did we have any questions out there? I don't see any questions out there. Oh, can we download the meeting presentation? Elise, I believe are we gonna be sending this to everybody? I know you're muted, but.
Yep, I will send that out after this and the recorded session as well. And please send us any more questions you have as well.
Perfect. And this last slide is our QR code that everybody uses a QR code these days. If you aren't, a lot of you I know are clients and you probably were on their email list. If you're not, and you want to get on our email list, we do a newsletter. We just launched one, I think today. It has a lot of good content and education material. You'll get information on our surveys and the conferences we attend. Go ahead and scan it, sign up. You'll get on our list and you'll get some hopefully good content from us via email. But we've got 2 minutes, so I don't see any questions out there. You've got an extra 2 minutes, so you can go now 1 minute, so you can maybe get a cup of coffee. But I thank you for your time today. I hope you all have a great day and a great rest of your week. Take care. Bye-bye.